You can outperform 88% of professional fund managers by using this simple investment strategy. Introduction. Hey everyone, welcome back to the channel. Today, we're going to dive into a powerful yet simple investment strategy that can help you outperform 88% of professional fund managers. Yes, you heard that right. You don't need a fancy degree or insider knowledge to beat Wall Street's top pros. Stick around to find out how you can start today. The myth of professional fund managers. Professional fund managers are often seen as the pinnacle of investment expertise. They manage billions of dollars, have years of experience, and are well paid for their skills. But here's the shocking truth: most of them aren't worth the fees they charge. Despite their education and experience, the majority fail to outperform the market consistently. Warren Buffett's famous bet. One of the most famous examples of this comes from none other than Warren Buffett. In 2007, Buffett bet $500,000 that a simple S&P 500 index fund would outperform a collection of hand-picked hedge funds over a decade. The result? Buffett won the bet handily. This experiment showed that you don't need complex strategies or insider knowledge to achieve superior returns. The simple strategy: invest in an S&P 500 index fund. So, what's the secret strategy? It's incredibly simple. Buy an S&P 500 index fund, such as the Vanguard S&P 500 ETF, VOO. By doing this, you can expect better long-term returns than most actively managed mutual funds. Let's break down why this works. The failure of active large-cap funds. S&P Global publishes its SPIVA, S&P Indices versus Active, scorecards twice a year. These scorecards compare the performance of active mutual funds to relevant S&P benchmark indexes over various periods. As of the end of 2023, they found that 88% of active large-cap funds failed to beat the S&P 500 over the last 15 years. Even over a shorter 3-year period, about 80% failed to outperform the benchmark. Why active funds underperform? There are two key reasons why active funds struggle to beat a simple index fund. Market dynamics. For every transaction in the stock market, there's a buyer and a seller. When it comes to large-cap stocks, these transactions are typically between institutional investors, meaning one fund manager is usually buying from another. They can't both be right, which makes it difficult for active managers to consistently outperform the market. Fees. Fund managers, their teams, and the institutions they work for all require compensation. This means investors have to pay fees, such as the expense ratio, which can exceed 1%. These fees make it harder for fund managers to outperform the market by enough to cover their costs and provide a net gain to investors. As a result, only around 40% of actively managed mutual funds outperform the S&P 500 in any given year. Very few manage to do so consistently over the long run. Reducing your cost of participation. To outperform the average investor, you need to minimize what Vanguard founder Jack Bogle called the cost of participation. This term refers to the cost you incur when investing your money. Investing has become easier and less expensive over the past 25 years. Most brokerages now offer commission-free stock purchases, and average expense ratios for mutual funds have significantly declined. Nevertheless, it's crucial to keep costs as low as possible by avoiding unnecessary fees. The Vanguard S&P 500 ETF, low cost, high return. Active mutual funds, on average, cannot outperform their fees. Instead, consider buying the Vanguard S&P 500 ETF, which charges a minimal fee of just 0.03%, or $3 for every $10,000 invested. This ETF offers a low-cost way to match the market's performance. While some fund managers may outperform their fees over time, identifying those funds in advance is challenging. Moreover, it's difficult to determine whether their success is due to skill or luck, making it uncertain whether they can continue to outperform. Therefore, an S&P 500 index fund remains your best bet. Why Buffett chooses the Vanguard S&P 500 ETF in his wager against fund managers. Warren Buffett chose the Vanguard S&P 500 index fund. Berkshire Hathaway even holds a small amount of the S&P 500 ETF in its equity portfolio. Several factors make this ETF his top pick. Low expense ratio. With an expense ratio of 0.03%, it's one of the best in the industry. Low tracking error. Tracking error measures how closely the ETF matches the performance of its benchmark index. A low tracking error ensures that the ETF's performance mirrors the index, providing consistent returns for regular investors. There are many index fund options, but the Vanguard S&P 500 ETF stands out as a top choice among all large cap stock funds. The power of compounding. One of the most compelling reasons to invest in an S&P 500 index fund is the power of compounding. Over time, the returns generated by the index fund will grow exponentially, as you earn returns on your returns. This compounding effect is a significant advantage of long-term investing in a low-cost index fund. Diversification with an index fund. An S&P 500 index fund provides instant diversification, as it includes 500 of the largest companies in the United States. This diversification reduces your risk compared to investing in individual stocks. By owning a broad swath of the market, you're less exposed to the volatility of any single company. Rebalancing your portfolio. Even with an index fund, it's important to periodically rebalance your portfolio. This means adjusting your investments to maintain your desired asset allocation. For example, if your goal is to have a portfolio that's 70% stocks and 30% bonds, you'll need to periodically sell some of your stock holdings and buy more bonds if stocks have performed well and now make up a larger percentage of your portfolio. Staying the course. One of the biggest challenges for investors is staying the course during market downturns. It can be tempting to sell your investments when the market drops, but this often leads to selling low and buying high. Instead, focus on your long-term goals and maintain your investment strategy. Over time, the market tends to recover, and you'll be better off sticking with your plan. The importance of a long-term perspective. Investing in an S&P 500 index fund requires a long-term perspective. While the market can be volatile in the short term, it has historically provided strong returns over longer periods. By staying invested and avoiding the temptation to time the market, you can benefit from the long-term growth of the U.S. economy. The role of dividends. Dividends play a significant role in the total return of an S&P 500 index fund. Many of the companies in the S&P 500 pay dividends, which are typically reinvested in the fund. Over time, these dividends can significantly boost your overall returns. The benefits of dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market's performance. This approach reduces the impact of market volatility on your investments and ensures that you're buying more shares when prices are low and fewer shares when prices are high. By consistently investing in an S&P 500 index fund, you can take advantage of dollar cost averaging and build wealth over time. Avoiding market timing. One of the biggest mistakes investors make is trying to time the market. This involves attempting to buy low and sell high, but it's incredibly difficult to do consistently. Even professional fund managers struggle with market timing. Instead, focus on a long-term investment strategy and avoid the temptation to make short-term trades based on market fluctuations. The power of automatic investing. Many brokerages offer automatic investing plans, where you can set up regular contributions to your S&P 500 index fund. This automated approach ensures that you're consistently investing, taking advantage of dollar-cost averaging, and staying on track with your long-term investment goals. The role of tax-advantaged accounts. Investing in an S&P 500 index fund through tax-advantaged accounts, such as a 401k or IRA, can help you maximize your returns. These accounts offer tax benefits that can boost your overall investment growth. For example, contributions to a traditional IRA may be tax-deductible, while investments in a Roth IRA grow tax-free. The importance of financial education. To make the most of your investments, it's essential to continue educating yourself about personal finance and investing. There are numerous resources available, including books, online courses, and financial advisors. By staying informed, you can make better investment decisions and achieve your financial goals. The value of patience. Investing in an S&P 500 index fund requires patience. The market will have ups and downs, but over the long term, it has historically provided strong returns. By staying patient and sticking to your investment strategy, you can build wealth and achieve financial independence. The benefits of low turnover. Index funds typically have lower turnover compared to actively managed funds. Turnover refers to the buying and selling of securities within a fund. Lower turnover results in lower transaction costs and fewer taxable events, which can enhance your overall returns. The Vanguard S&P 500 ETF, for example, benefits from this low turnover strategy. The psychological advantage. Investing in an index fund can provide a psychological advantage by reducing the stress and anxiety associated with frequent trading and market speculation. By adopting a passive investment strategy, you can avoid the emotional roller coaster of trying to beat the market and focus on long-term wealth accumulation. The role of asset allocation. While an S&P 500 index fund can form the core of your investment portfolio, it's important to consider your overall asset allocation. This involves diversifying your investments across different asset classes, such as bonds, real estate, and international stocks, to manage risk and enhance returns. A well-diversified portfolio can provide more stability and growth potential over the long term. The importance of consistency. Consistency is key when it comes to investing. Regular contributions to your S&P 500 index fund, regardless of market conditions, can help you build wealth steadily over time. By maintaining a disciplined approach, you can avoid the pitfalls of market timing and benefit from the power of compounding. The long-term outlook. The long-term outlook for the S&P 500 remains positive. The U.S. economy continues to grow, driven by innovation, entrepreneurship, and a strong corporate sector. By investing in an S&P 500 index fund, you're effectively betting on the continued success of the largest and most influential companies in the U.S. Conclusion. In summary, you don't need to be a financial expert to outperform 88% of professional fund managers. By investing in a low-cost S&P 500 index fund, you can achieve superior returns over the long term. Remember to focus on minimizing costs, maintaining a long-term perspective, and staying consistent with your investment strategy. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more investment tips and strategies. Thanks for watching, and happy investing!